Hey, it's Matthew Decker here with Leveraged Wealth Management. I'm really excited today because for today's Takedown Thursday, I'm actually handing it over to Brady Watkins. Brady's been working with our office for about a year now. He's a young guy in this industry. He's very bright. He's got a ton of potential, and he begged me to do a Takedown Thursday, and I said, go for it, Brady. So I'm excited to introduce you to Brady Watkins. He's going to do this week's Takedown Thursday.
Hey YouTube, this is Brady Watkins with Leveraged Wealth Management. Hope you guys are doing well. I am very excited because I am here to share with you the next Takedown Thursday video of the week. If you haven't seen the other Takedown Thursday videos, what this series will entail is that we are going back into the archives of thousands of bad policy designs that we have received, and will receive each week. We get about 10 to 12 bad policy designs every single week. Until now, they have been rotting in a file, but we wanted to bring those out of commission to show you what is done wrong and how to fix these policies. So we've seen that there is a lot of misinformation about these index universal life products, and there are a lot of bad agents out there, whether they are new to the industry, don't have much experience selling these products, or they are a part of a multi-level marketing company. They are not out for your best interest. So we want to get this out. We want to talk about this because this can be the best thing you own, or it can be the absolute worst thing you own based on the design. So let's get started. And without further ado, let's go ahead and see what our next bad design is. So just as before, we have another policy, and this policy is going to be with Nationwide Life and Annuity Insurance Company. Just like the other policy videos that we've seen, I'm going to block out the information to kind of protect the innocent here. And we're basically just going to go through this one page at a time. I've went ahead and took out a few pages just so we can dig through this a little bit easier and I can pick out what I would like to pick out. So the first thing I want to go over really quickly just to cover the basis here is the general information of this policy. This is a male 46 preferred plus non-tobacco. It's a $500,000 death benefit. Option 2, increasing death benefit, $1,000 a month. And we have this long-term care rider of $500,000 a month. Now, the important thing to know here is that this client was hoping and asking for a maximum income and cash accumulation design, and this is what he was presented with. So the very first thing that I will look at in a policy to see if it is designed poorly is to see how much you're putting in, which in this case would be $1,000 a month, and how much is your death benefit, which is $500,000 in this design. So from a perspective of a quick just eye test, this $500,000 may not look like it is a max commission designed policy. But one of the things that we need to look out for is if this specified death benefit here is an even number, like 500,000 or 1 million or 2 million. And what this means a majority of the time is that we are dealing with an agent who is putting in a specific face amount and not having a minimum death benefit design according to the IRS limits. So look out for those even face amounts, that 500,000, the million, 2 million, anything like that. Be on the lookout for that. So that's the first red flag here. Obviously, this long-term care rider, if your main goal is cash and income, this long-term care rider, you're going to be paying for it regardless if you use it. That's an added cost. We don't want that in the policy. So going down here, this is just highlighting the long-term care rider. I want to go ahead and go to the next page where I see the next red flag here. This is kind of listing out the different kind of indexes that you are using. This policy is put 100% in this high cap multi-index. I just want to highlight this indexed interest strategy charge rate, which is charging a 1% asset-based charge to even have access to this index. It's not giving you a bonus. It's not giving you any kind of extra benefit for charging you. It is only giving you the ability to put in this index, and it's charging you a 1% guaranteed charge for the life of the policy, or as long as you are in this. If you chose the high cap S&P 500, you would also be charged that 1% guarantee. We don't like the extra charges on any policy. What that does is take away from the cash value, and also, as we've seen before, they are able to keep their indexes artificially high by charging this indexed interest strategy charge rate, a lot like Transamerica. And what that brings me to in my next point is on every single page on this policy, we have a little bit of evidence to see where this was from. WFG. Those three letters should make you run for the hills. WFG is a big multi-level marketing agency, and a majority, if not all, of the policies that we receive that they designed are designed for max commission, max death benefit, which is not the goal if your goal is max income. So I wanted to keep going here. WFG, very big red flag there. And now we're getting to the ledger part of the policy here. So we have a 6.99 illustrated rate based on this high cap that is getting charged a 1% asset-based charge. But regardless, let's just go ahead and look at this. What this is showing is a $12,000 a year premium outlay, $0 in the first year, $500,000 death benefit increasing, which is very interesting because usually we deal with a lot of level death benefit options that are inefficient, but this is an increasing design, so it could make you believe that this is a great design because it's an increasing design, lower-ish death benefit of $500,000. And you also have this benefit for long-term care here in the corner, $500,000 that's going to be available to you the entire life of the policy. Let's just go ahead and see how this performs here at a 6.99 illustrated rate. After 15 years, your cash value is at 207, and after 20 years, your cash value is around 331. And let's just go out to 30 years, 620, and 40 years, which is going to be $946,000. So looking at this policy, this is going to be tempting to say that this is a good policy design. You know, it's a relatively low death benefit. Obviously, it's a lower premium amount, about $12,000 a year. You know, the cash grows consistently well. The policy itself is an increasing death benefit. All of those things look pretty good from the outside, but we want to show you a few things that make this policy a bad design. And I also am going to show you a good design to kind of fix the problems, and then we can see what the differences are with this. So the main thing I want to show you here is going down a few pages to the guideline annual premium. Every single Takedown Thursday, we have to check this guideline annual premium. The rule of thumb here is that this has to be remotely close to what you're paying in premium. If it's not, it is a big indicator that your policy is not designed well. So let's go ahead and see what this is. So the guideline annual, $20,000. That's an $8,000 difference between the premium he is paying and this guideline annual premium of $20,419. So are you paying close to the guideline annual premium? The answer would be no. That is a huge indicator to show that this policy is obviously not designed for maximum cash income. And this is also an artificially high death benefit. I'm going to show you and prove that to you later. But with that, and on top of that, it's an increasing death benefit. Usually increasing is the right way to go, but with an artificially high death benefit, this actually makes the policy even more expensive, and you are paying nowhere near, actually 60 to 70% lower than what you need to pay to max fund this policy. So at this point, I want to show you what it would look like to turn this policy around, make it a good design. You know, Nationwide as a carrier isn't anywhere near our top favorites, but that doesn't matter right now. We want to show you what a Nationwide carrier, apples to apples, would look like as a good design. So let's go for it. So here, I just want to skip right to the ledger, get down to business here. This is still the same 46-year-old male, preferred plus non-tobacco, $12,000 annually. We've taken off this long-term care rider. But the big difference here and the deciding factor that will make this policy as efficient as possible is this specified death benefit amount is around $200,000 lower. It is not an even number like 500, a million, 2 million. This is a very specific number generated through a IRS limit of what this death benefit needs to be and how minimal can we get this in order to fund this policy with $12,000 a year and make it efficient as possible. So same $12,000 premium here. The first big difference here is this cash value in year one is $3,000 compared to this policy in the first year, no money at all. So that first year, $3,200. Let's go out to that same 15th year, $244,000. 15th year on the bad policy, $207,000. And let's keep going here down to the 20th year. The gap between these two policies is just going to get bigger as we go down. 20th year, $390,000. 20th year on the bad policy, $331,000. So that's a $60,000 difference after 20 years. And going down to 30th year, $759,000 in the 30th year with the good policy, and 30th year, $620,000 in the bad policy. So that's a $100,000 difference inside of 30 years. This policy going out into around the 40th year, age 86, you're at $1.3 million. And with this bad policy, the 40th year shows about $946,000. And so that is the difference in a good design versus a bad design. So hopefully this has been helpful. That really is one of the more subtle differences between good design and bad policy design. And I wanted to show you that specifically because even a very small tweak and difference can cost you about $100,000 within 30 years of your policy date. And so if you want your policy reviewed, I'm going to include a link below to go to our site to submit a policy to be reviewed by us. We are happy to do so. And so basically what your policy review will look like is very similar to this. We will go through your policy and also present some recommendations. And so if you feel like your agent is after their own interest, we are happy to be the second pair of eyes on your policy to see if the design is as efficient as possible for your goals. So this has been another successful Takedown Thursday. We are looking forward to seeing you next week.